When do you start to pay yourself? And how much? This is a question that some business owners treat as an afterthought. Some business owners are so focused and driven to create a business, brand, or idea that they forget that they need money to survive. It's expensive to live, eat, have shelter, and have a car. So you need to ensure before you get going that you'll be able to generate enough income from the business so that you can afford to live. Surely there will be startup costs or initial investments made, but most businesses should be able to afford to pay the owner something within the first 3 months. It's not a question of when, it's a question of how much, and ensuring that the owners can live on that. To figure out if the business can afford to pay you what you need, we'll start with the known amounts and add in all the other expenses that need to be paid to figure out what our break-even is for sales. Then we can figure out if that monthly sales number is reasonable or if there's anything else that we can adjust to ensure that you can bring home what you need to. So the first step is to understand how much you need to bring home every month to cover all of your personal expenses. Clothing, food, your home, health insurance, entertainment, subscriptions, gifts, all together, is that $1,500 a month? $2,500 a month? I'll use $3,500 per month. If the business is borrowing money right from the start, I'll need to factor that into my monthly requirements too. So let's just say that our monthly debt service in the business is $650. So the cash that the business needs to have monthly to pay you and its debts is $4,150. But we're forgetting about one large item that isn't a tax deduction. Income taxes will vary based on where you live and where you're doing business. But to play on the safe side, let's assume that 30% of your business profit, whether you take the money out of the business or not, so if your total business profit per month is $6,500, that's what will be taxed on. And we should save about $1,950 from that $6,500 in profit for taxes. And that's 30%. $650 of it will go to debt payments. And $3,900 is for me to take home, or take home only $3,500 and leave the rest in the business. So let's talk about how I got to that $6,500 in business profit per month. So I know that my monthly overhead is $15,000, so that means that my monthly gross profit needs to be $21,500. If the cost to make a sale is 25% of the sale price, that means that I can divide $21,500 by 75% to figure out that $28,667 is the monthly sales that you need to generate to be able to take home that required $3,500. And that calculation is based on the business generating a profit and still having enough cash left over to pay its taxes, its debts, and the owner. So let's make that a little bit easier to read. Let's flip around the equation to look like a regular profit and loss statement. And if I play around with the numbers a little bit, you can see that if I bring in an extra $10,000 in sales per month, assuming that overhead stays the same, there's just two expenses that are important to recalculate before you know how much in free cash flow there is to either pay yourself or to reinvest in the business. So your cost of goods sold are at 25%, which means that on $10,000 of sales, you'll have an extra $2,500 of expenses. So the monthly income from the business increases from $6,500 to $14,000 with the additional $7,500 of profit. But that doesn't mean that that $7,500 goes right into your pocket. That $7,500 hasn't been taxed yet. So you have to save another 30% for taxes, or $2,250. And then the other $5,250 is yours to leave in the business and reinvest or to take it out. So many business owners make the mistake early on of earning that $6,500 per month, paying their debts, and then spending the rest on themselves. 10 months go by and all of a sudden it's tax time. And that $1,950 in taxes that you should have been saving every month for those 10 months were spent a long time ago. And there's no money left to pay the tax owed. And all of a sudden, you're behind the 8 ball. And you have to dig your way out. And the way to do that is by generating sales, which are also taxed at 30%. So save for taxes from the start. And understand what you're taxed on. It's your business profit, not what you take out of the business. Okay, back to my monthly average. It's important to know that $28,667 in sales per month is almost $350,000 per year. Are you able to do that? I know you are, but this is why understanding your numbers is so important. If you can get your overhead down from $15,000 a month, you can reduce the number of sales that you need to make. And if you increase those sales, you can see how it directly impacts the amount of money that you can take from the business after saving for taxes. So do this exercise early on in the business and continue to do it as you're projecting future months and years, and as your business continues to grow and cost you more. It's important always to ensure that you have a comfortable life at home to be the best business owner that you can be when you're at work. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.